Getting paid in cash does not make it tax-free. And the idea that the IRS has no way to find cash income is one of the most expensive myths in taxes. So let's do this honestly. What the IRS actually can and can't see, what you're really required to report, and how to handle cash income the right way. Let's break it down. Start with the law, because it's simpler than people want it to be. All income is taxable, period, whether you're paid by cash, check, app, card, crypto, or even a trade of services. The form of payment doesn't matter. Income doesn't have to be reported on a 1099 to be taxable. If you earned it, it counts. Now the question everyone actually asks, how would they even know? Here's the honest answer. The IRS usually cannot see your individual cash payments directly. There's no report when a customer hands you $40. That kernel of truth is exactly why the myth survives. But it's only half the story, and the other half is where people get hurt. Because here's how unreported cash actually surfaces. The number one method is a bank deposit analysis. In an audit, the IRS adds up everything you deposited and compares it to what you reported. If you deposited far more than you claimed to earn, that gap is treated as unreported income, and now you're explaining it, not them. And that's not the only tool. There's the lifestyle audit. If you report $20,000 but live like you make $80,000, that mismatch draws attention. There's matching against 1099, KS, and other third-party reports. There are industry benchmarks for what a business like yours should earn. And yes, there are tips from ex-partners, competitors, and former employees. There's also a direct one most people don't know about. Any business that receives more than $10,000 in cash from one buyer has to report it to the IRS on Form 8300. So pay cash for a car or a big-ticket item, and that payment is visible, even though you handed over physical bills. And the IRS knows exactly which industries run on cash. Audits aren't random. Returns get a risk score, and cash-heavy businesses like food service, construction, salons, and vending are scored as higher risk. So a cash business isn't invisible. Statistically, it's watched more closely than a W-2 job. So here's the honest reframe. It's not that the IRS watches every dollar you make in cash. It doesn't. It's that the gaps surface over time, and when they do, the penalties are brutal. You're not betting against a camera. You're betting against bank records, benchmarks, and time. And the penalties are the real reason to get this right. Underreport, and you can face an accuracy penalty of 20% of the tax you underpaid, plus interest that keeps running. If it's judged to be deliberate fraud, the civil penalty jumps to 75%. And willful evasion can be a crime. That last one is rare and reserved for serious cases, but the civil penalties are common. Okay, so how do you handle cash income the right way? If it's from a business or a side gig, it goes on Schedule C, the same form gig and self-employed workers use. You report all of your gross receipts, cash included, then subtract your expenses to land on your net profit, and that profit is what's taxed. And here it is, straight from the IRS. This is Schedule C. Line 1, gross receipts or sales, is where all of your income goes, and the word that matters is all. That includes every dollar of cash you took in, whether a form was ever issued or not. This is the line people are tempted to shrink, and the one the bank deposit method checks. A quick word on tips, since they're usually cash. Tips are taxable income. If you're an employee, you're supposed to report them to your employer so they're on your W-2. Anything unreported gets picked up on Form 4137 when you file. Either way, cash tips are income. They don't get a pass for being handed to you directly. Same with bartering. If you trade your work for someone else's goods or services, a plumber fixing a pipe in exchange for a website, both sides have taxable income equal to the fair market value of what they received. No money changes hands, but the IRS still treats it as income on both ends. Now the part that makes honest reporting far less painful than people fear. Cash business income gets all the same deductions. Your mileage, your supplies, your phone, a home office, every legitimate expense lowers the cash profit you're taxed on. Report the income, but don't forget to claim everything against it. That's how the real bill shrinks. The key habit is simple record keeping. Keep a basic log of your cash income, date, amount, and source, and deposit it consistently so your bank records and your return tell the same story. Your records aren't just for the IRS. They're your defense if you're ever asked. Good records turn a scary audit into a non-event. Let's run 2 examples. 1. A handyman paid $30,000 in cash this year, number 1099s at all. Every dollar of it is Schedule C income. But he tracked his mileage, tools, and supplies, about $8,000 in real deductions. So his net profit is $22,000. He's taxed on $22,000, not the full $30,000. His self-employment tax on that $22,000 is about $3,100 plus some income tax. That's the honest cost, and with his deductions, it's manageable. Reporting it cleanly, with records, means even if he's ever audited, the numbers match and it's a non-event. 2. The catch. Someone takes in cash all year and deposits $45,000 into their bank account, but reports only $20,000 on their return. In an audit, the deposit analysis surfaces a $25,000 gap with no explanation. That gap is now treated as unreported income, and the tax, the 20% penalty, and interest all land on it. And that's the whole point. The $25,000 they tried to hide ends up costing the original tax, plus a penalty, plus years of interest, frequently more than they ever saved by skipping it. Meanwhile, they gave up all the deductions they could have claimed. Honest reporting with deductions is almost always the cheaper path. So here's your system. Report all of your cash income. Keep a simple log and deposit consistently. Claim every deduction you're entitled to. And set aside money for self-employment tax so the bill never surprises you. Do that, and cash income is just income. Fully legal, fully handled, nothing to fear. Quick recap. All income is taxable, cash included, form or no form. The IRS can't see each payment, but bank deposits, lifestyle, benchmarks, and time surface the gaps, and the penalties are steep. Report it on Schedule C, keep records, and claim your deductions. Honest and documented always beats hidden and hoping. One quick note on who makes this. The tax breakdown is prepared by a tax accountant with over 15 years of public accounting experience, so every figure here is checked against the IRS sources. It's always educational, never advice for your specific situation. Bottom line, cash income is real income, and the smart move isn't to hide it. It's to report it and shrink it with every deduction you're owed. That's legal, it's cheaper than getting caught, and it lets you sleep at night. This is general education, not tax advice, so check with a pro about your situation. Subscribe to the Tax Breakdown for simple tax-saving tips before you file.